Welcome to Talk Tickers.
Your shortcut to understanding key earnings calls.
Exactly. You're busy, we get it, but you need the pulse on the big players. That's us.
And today we're diving into KKR. They just had their earnings call.
Yeah, KKR, the global investment giant. We'll give you the rapid download, what they reported, and maybe more importantly, what it all signals.
And the overall picture, pretty strong, actually. Significant growth in key metrics.
Definitely seeing continued momentum across their business lines.
So let's jump into this snapshot. The headline numbers were, quite good.
Yeah, what stood out first?
Well, fee-related earnings, or FRE, per share hit $0.92. That's up 22% year over year.
Wow, 22%. That's a solid jump.
It is. And total operating earnings, TOE, landed at $1.24 per share. That's up 16%.
Okay, strong FRE, strong toe. What about adjusted net income?
ANI was $1.15 per share, also strong, up 19% compared to last year.
Right, and management highlighted these figures, didn't they?
They did. They specifically pointed out these are, among the highest they've ever reported as a public company.
Which certainly tells you something about the quarter they just had. So a powerful start. Let's maybe unpack what's driving this.
Sure. Management fees are a big piece, obviously. They grew to $917 million.
Up 13% year over year. That comes from successful fundraising and putting capital to work.
Exactly. But here's the interesting part. Like you alluded to, this growth doesn't even fully capture the $31 billion of new capital they raised in Q1.
Because the big North America fund, ArcGV, hadn't technically started earning fees by the end of March.
Precisely. So there's a lag. It suggests, a bit of a built-in growth engine for those management fees in the coming quarters. You see that?
Yeah, that makes sense. Latent fee potential.
Okay.
What else contributed? Transaction fees.
Yep. Transaction and monitoring fees brought in $262 million total.
And the capital markets piece was significant there.
Huge. $229 million just from capital markets transaction fees. That signals a lot of activity within their portfolio companies, buying, selling, refinancing.
Both PE and infrastructure, I imagine.
That's right. And then you have the fee-related performance revenues. That's like their share of the profits when things go well.
How much was that?
$21 million for the quarter. So you put all that together.
Total fee-related revenues hit $1.2 billion. That's that 22% year-over-year increase we mentioned.
Exactly. And the earnings from that, the fee-related earnings, were $823 million.
Which leads to that impressive FRE margin, 69%.
Yeah, 69%. That really tells you how efficient that core money management business is running right now. Very profitable.
Definitely highlights the profitability. Okay, beyond the core asset management, how did insurance and strategic holdings do?
They performed well, too. Insurance operating earnings came in at $259 million.
And strategic holdings?
$31 million in operating earnings. Both numbers were basically in line with or maybe slightly ahead of their recent guidance.
Seems like strategic holdings are getting more focused. They added to it, right?
They did. They bought more stakes in 3 existing core PE businesses they already held.
And acquired KRO Healthcare.
Correct. So that brings the total portfolio there to 19 companies.
And the scale is quite large now. Their share of revenue and EBITDA across those 19 companies is, what was it?
Around $3.8 billion in annual revenue and about $920 million in EBITDA. It's substantial.
So that provides a more stable, recurring element to their earnings. Useful when markets get choppy.
Absolutely. And actually, over the past year, if you look at total operating earnings, that includes FRE, insurance, strategic holdings, it made up almost 80% of their total segment earnings.
Wow, 80%. That really underscores the diversification push.
Now, shifting gears a bit to the investing side of asset management, monetization activity was up.
Right, selling investments. How much did they realize?
Total monetization was $566 million. That's up almost 40% from the same time last year.
40%. What drove that big jump?
Mostly the annual crystallization of carry, their profit share from core PE, plus some other successful exits.
And that implies the underlying portfolios are doing okay?
Seems so. The private equity portfolio itself was up 4% in the quarter.
And over the last year.
Up 11% over the last 12 months. They mentioned geographic diversification helped, particularly strength in European and Asian equity.
And real assets and credit, also positive.
Yeah, positive performance there, too.
Okay, so good performance, good realizations, and good news for shareholders, too, with the dividend.
Yes, 6th consecutive year, they've increased the dividend.
What's the new level?
Annualized is now $0.74 per share. So that's beta 0.185 cents per quarter.
That consistent increase Definitely signals confidence from management in ongoing earnings power.
Absolutely. So that covers the main results. But the call went deeper, obviously. Broader themes.
Like tariffs, that's always a hot topic. How do they see the impact?
They estimate that about 90% of their global private equity AUM has limited or even no direct impact from the announced tariffs.
And that's before considering any mitigation steps they might take.
Right. They also see minimal impact on infrastructure. Things like contractual protections help there.
What about credit? Some exposure expected.
Some, yes. But their view is that the opportunities opening up in the credit market because of the uncertainty might actually outweigh the downsides from tariffs.
Interesting take. Sounds like they're actively managing these macro risks. They also talked about deploying capital, right? Putting money to work.
Yeah, very active. Over $30 billion in new investment commitments just since the start of the year.
And a lot of that outside the U.S.
More than half, actually, including some significant deals in Japan.
And despite market swings, they still see a path to selling investments, monetizations.
They do. They mentioned a healthy pipeline and a direct line of sight to over $800 million in monetization-related revenue.
With how much expected soon?
Q2. At least $250 million expected in Q2 alone. And the total pot of unrealized profit, their gross unrealized performance income, hit a record $8.7 billion.
$8.7 billion unrealized. That's up significantly.
Up over 25% year on year. So that ability to invest through uncertainty, plus that big unrealized cushion, it provides a pretty solid foundation.
Definitely. What about raising new capital? Still feeling confident despite the markets.
Seems so. They raised that $31 billion in Q1 we mentioned. That included a really strong initial close for North America Fund, APE, at $14 billion.
And their regional strategy helps there, right? Separate funds for North America, Europe, Asia.
Yeah, that differentiated approach seems to work well for them. Plus, the private wealth side is really picking up steam.
The K-series vehicles, how are they doing?
AUM there hit $22 billion as of early April 2025. Compare that to just $9 billion a year ago. Massive growth.
Wow, doubling and then some. That's tapping into a whole new investor base.
Absolutely.
Yeah.
And they also launched those new public-private credit solutions with Capital Group.
Right, broadening the reach again.
Okay.
Let's touch on Insurance Global Atlantic. They own it fully now for about a year.
Yep. About a year into 100% ownership. They're making progress, evolving it, changing the liability mix, how they source assets.
Raising more third-party capital for it, increasing alternatives exposure.
Exactly. Q1 operating earnings were $259 million, right in line. They expected to stay around that $250 million mark, plus or minus, for the next few quarters.
And the overall return target.
The all-in pre-tax ROE is getting close to 20%, and they see a clear path to getting above 20%.
How are they doing there?
Key things. Elongating liabilities, like 90% of retail annuities sold in Q1 had a duration over 5 years. Increasing alternatives added about $1 billion in Q1, now at 1% of the portfolio. And growing that third-party capital.
So a deliberate strategic shift in the insurance business for long-term value.
Clearly. They also stressed the durability of their overall model.
How so?
Over 90% of their capital is either perpetual or locked up for, on average, 8 years or more.
That's sticky money.
Very sticky. Plus, $116 billion committed but not yet invested, and a record $64 billion committed but not yet earning fees.
Not earning fees yet. What's the potential fee rate on that?
Weighted average is about 100 basis points, so 1%. That gives you significant visibility into future management fee growth.
Right? Huge built-in growth. Plus, global diversification helps stability.
Yeah, almost half their investment pros are outside the U.S. Management fees are spread across asset classes. It builds resilience.
So they paint a picture of resilience, navigating the current environment. Did they talk much about that specifically?
They did. They emphasized their experience through cycles, saying volatility often creates the best opportunities.
And they're acting on that, investing now.
Definitely. They mentioned announcing over $10 billion in investments just in the 4 weeks after the latest tariff news broke.
Wow, leaning in. So while maybe some sale processes get delayed, they're optimistic on deployment and monetization overall.
Correct. Fundraising still strong, minimal exposure to China-based LPs, private wealth flows unaffected, and importantly,
They reaffirmed their 2026 guidance.
they did. No backing down from their long-term target.
Okay, what about specific growth areas? Asia.
Big focus there. They see huge opportunities in their Pan-Asian cross-asset class business, 9 offices, nearly 600 people on the ground.
Intra-Asia trade is a theme.
A growing one, yeah. And Asia AUM has grown and diversified a lot since 2019.
And private wealth. Again, they think Strong relative performance might actually accelerate adoption.
That's their thesis. When traditional markets are down, alternatives look more attractive, potentially speeding up adoption by wealth clients. Q1 flows were strong and geographically diverse.
Makes sense. How about using their own capital? Capital allocation priorities.
Consistency is key for them. Focus on generating the most long-term earnings per share and improving the quality of those earnings.
So buybacks, still part of the plan.
An important part, yes. Alongside investing in core PE, strategic M&A like KRO Healthcare, and building the insurance business.
And management alignment.
Senior management owns roughly 30% of KKR, so their interests are pretty well aligned with shareholders.
Good point. Another area they highlighted was asset-based finance, ABF.
Yeah, that's become a really significant business, $74 billion in AUM, up a lot year over year.
And they see a big market opportunity there.
Huge expanding end market, high barriers to entry, attractive risk-reward profile, and they think the current environment is quite favorable for ABF.
Okay. Capital markets fees Q1 was solid at $230 million. Q2 outlook.
Pipeline still solid, they said, but maybe slightly below Q1 levels? Potentially.
But long term.
Significant upside, especially tying into the insurance business as it grows. They mentioned about 2/3 of Q1 transaction fees were debt-focused, which is pretty typical.
Got it. Thinking bigger picture, how do they see the PE landscape evolving?
They expect more dispersion in results between managers, winners and losers.
And institutional investors will focus on fewer, better managers.
That's the idea. Consolidation of capital with the top performers. And volatility that creates opportunity for firms like them with capital ready to deploy.
Makes sense. Capital Group Partnership, they seem excited about that.
Very excited. 2 credit products launched already. More coming in PE, real assets, even things like model portfolios and target date funds eventually.
Aimed at a broader audience.
Yeah.
Even non-accredited investors.
That's the long-term vision, yeah. Bringing alternatives to more people through that partnership.
What about their own flagship fundraising, North America Fund 14?
Progressing well after that strong first close. Asia flagship fundraising is becoming a priority now, too.
And Infrastructure Fund V.
First close was last July, making progress there as well. They made a point to highlight fundraising across many strategies, not just the big flagships.
Right, it's a broad platform. What are they hearing from their big institutional clients, LPs?
Generally, clients are in healthy shape. They're processing the current environment, looking for spots to deploy capital.
Especially in credit.
Particularly traded and opportunistic credit, yeah. There's a sense of cautious optimism, maybe a fear of missing out on good entry points.
FOMO, even for institutions. Interesting. Back to the FRE margin, they think mid-60s is sustainable, even though they're near high 60s now.
Yeah, they believe mid-60s is sustainable long-term. They are investing back into the business growth initiatives, distribution costs for the Capital Group Partnership, et cetera.
But revenue growth should outpace costs.
That's the expectation. Revenue growth outpacing headcount and complexity, which could lead to further margin expansion over time.
Okay. They also gave more detail on tariffs, right? Beyond the 90% PE number.
Yeah, they reiterated that the initial 10% estimate for potential PE impact excludes mitigation efforts. Infrastructure, minimal impact. Credit, potentially even less exposure than PE.
And they have internal teams focused on this.
Deeply embedded macro, geopolitics, and public policy team helps them anticipate and react. Plus, their investment focus is on companies with durable demand, pricing power, things that help in a higher cost world.
Makes sense. For insurance, what's the key metric for investors to watch?
They emphasize the all-in ROE that's approaching 20% with the path higher. It includes the insurance operating earnings, third-party fees, and the investment management agreement.
So don't just focus on the near-term insurance operating earnings in isolation.
Exactly. They're managing those intentionally right now as the business model evolves for the long run.
Got it. And the capital markets keys tied to insurance potential growth there.
Huge potential, they think. From maybe $50 million last year, Q1 25 was $20 million, to potentially hundreds of millions over time.
Leveraging investments in structured products, private IG, distribution.
Right, but focused on long-term sustainable growth, not just a quick spike.
Okay, last point, management fee growth outlook. Still expecting acceleration.
Yes. Driven by that $64 billion of committed capital not yet earning fees at that roughly 100 basis point average rate.
Plus ongoing fundraising momentum.
And North America Fund X40 specifically starts contributing in Q2 2025, so you'll see a partial benefit then.
Okay, so summing it up. Strong results now, but also a lot of pieces strategically positioned for future growth across different engines.
So that's a good way to put it. A company firing on multiple cylinders, it seems.
Right. Okay, let's shift gears. Time for our segment where we think a little differently. Remember, everyone, this is absolutely not financial advice. Do your own research.
Definitely not advice, just sparking ideas.
So given KKR's big push into asset-based finance, right, and this idea that market volatility pushes companies towards off-balance sheet solutions, here's a wild thought.
Okay, let's hear it.
What about going long companies that specialize in retrofitting existing commercial real estate? Think old office buildings, empty warehouses with advanced vertical farming tech. But here's the twist. They focus on signing long-term leases directly with major grocery store chains for the output.
Vertical farms supplying grocery stores directly from retrofitted buildings.
Okay, where does ABF come in?
Oh, think about it. KKR and others are expanding ABF, looking for yield, especially in areas like sustainable ag and food security. These long-term leases with creditworthy grocers, they become predictable, recurring revenue streams.
So those leases could potentially be bundled and securitized, attractive assets for ABF investors.
Essentially. You get exposure to a growing, essential sector local food production with stable cash flows backed by big retailers. Compelling yield in an uncertain world. Maybe. It's out there, connects few dots. It's definitely unconventional. An interesting angle linking ABF growth to sustainable infrastructure and retail. Food for thought, literally.
Indeed. Okay, that wraps our deep dive into KKR's latest earnings call. We covered a lot. The strong numbers, the strategic moves in insurance, private wealth, ABF, their whole outlook, really.
Yeah, from the high-level results down to the details on tariffs and capital allocation.
So what stood out most to you listening in? Was it that private wealth explosion, the insurance transformation, their confidence in navigating the current market?
Lots to consider. Remember, this was our take, our distillation.
Absolutely. For the full picture, the complete context, definitely check out the actual earnings call transcript and KKR's investor materials.
It's always worth going to the source.
For sure. Join us next time on Talk Tickers. We'll be back to unpack another crucial earnings report, giving you the insights you need.
Quickly and thoroughly. Thanks for tuning in.